This is Chris Carlson, and welcome to the Boulder Banking Podcast. My guest is Scott Hein, Emeritus Professor of Finance at Texas Tech University. Scott is a sought-after speaker and has been on the faculty of multiple banking schools, to include GSBC. I know you will enjoy my conversation with Scott, in which we discussed the economy, his views on inflation and interest rates, how the Federal Reserve is doing, and his thoughts on what banks should be doing in the midst of all of this. Hey, Scott, thanks for joining me today.
You're welcome. Look forward to it.
Hey, Scott, we got a lot of things that I really want to get to today. But before we get started, can you give us kind of the brief background of Scott Hein?
You bet. Professionally, I would say I'm a retired finance professor. I retired a couple years ago from Texas Tech University. I taught here in the finance department for over 30 years. Prior to that, I was a senior economist at the Federal Reserve Bank of St. Louis from 1979 to 1983, which really, that's when I cut my teeth professionally. I'm originally from Albuquerque, New Mexico, grew up there and went to the University of New Mexico as an undergrad, pursued my PhD at Purdue University. One of the wisest decisions I ever made was to marry young. I was 18 years old, and my wife and I married then, and happy to report this Veterans Day, we will celebrate our 55th wedding anniversary. So it's been a wonderful ride. Just on a personal note, family is really, really important. We have 2 daughters, 5 grandchildren, and now a great-granddaughter. So we're blessed with a tight-knit family. One quick anecdote here, or piece of personal information. I was diagnosed with melanoma cancer stage 4 back in 2006. Ultimately, it migrated to my kidney. In 2011, my oncologist said to my wife, why don't you line up hospice? And my wife and daughters said, that's not a good idea, and reached out and tried to find another oncologist. And fortunately, I was able to go to MD Anderson and was treated there, ultimately removed my left kidney where the cancer had migrated to, and had a couple of surgeries after that. And today I'm now some 8 years cancer-free. So I'd like to report some good news on the health front and relay to your listeners.
Scott, I really appreciate that because, you know, what's really fascinating in your the first wave of what is happening, you know, with medical technology and the advances and the ability to take care of people, to extend their life, as opposed to, as you said earlier, you know, that stinking thinking that one doctor had, you know, let's start packing it in.
Exactly. I did have immunotherapy before it was FDA approved, and I attribute much of that success. They call me a failure because it didn't kill off the cancer. Ultimately, I had to have surgery a number of times to remove the cancer. But I do attribute that immunotherapy, which now is FDA approved, to helping me stay healthy these days. It's remarkable. I did a couple of rounds of chemo, and that was horrible. The immunotherapy, I'm happy to report, was nothing in comparison. I really thought I was on a placebo. I couldn't have any effects that I felt. Chemo, on the other hand, was a different matter.
Well, Scott, that's the good news. And maybe I'm going to turn something now that maybe is not such good news. How would you describe the general state of our economy?
That's a interesting matter. I think for the most part, the economy is functioning well. And I would say if you look at the labor market, the unemployment rate's very low. It looks like there's a number of job openings out there for anybody that's looking. And by that, we would say the economy is pretty healthy. Consumers seem to be willing to buy. I do worry about the other side, though, and that is the inflation situation. I think part of this sense that things are good is false. We look at things through how many dollars we're getting, and unfortunately with inflation, those dollars aren't buying what they did before. I worry greatly about the inflation situation. And as you know, the news that we just got with the consumer price index increasing 8.5% from a year ago is very troubling. And I'm concerned on that front.
And in terms of the inflation, do you think and again, we're not going to get into politics today necessarily, but we talked about transitory. Is this going to be a longer term issue than even the non-politicians are thinking?
I really think it is. I remember, as I said, back to the late 1970s and early 1980s, the fight we had to rein in inflation at that time. It was very difficult. And the analogy I remember is inflation is like toothpaste. Once it gets out of the tube, it's very difficult to get back in. And I think that's the case today. I fear inflation is escalating, and I fear that this 8.5 is not going to be the peak. I've been reading many are saying that's now the peak and they're seeing signs. I don't see it myself in this environment. I worry going forward. I wouldn't be surprised if we see 10% consumer price inflation this year myself.
Wow.
Let me just say, forecasting inflation is a damn difficult matter, and I don't consider myself really able to fine-tune that forecast, but I do have a fear.
Appreciate that. Well, kind of go hand in glove with inflation. We read a lot about and hear a lot about interest rates going up. Where are they headed, and should we be worried?
I think we should be worried. I think the Federal Reserve has really done us a disservice, and I'd really go back to even 2008 when we started the quantitative easing. And that's just buying government securities and mortgage-backed securities with the intent of adding them to the Federal Reserve's balance sheet. I think that drove interest rates down, and economists really have always said low interest rates are good. And I know President Trump was a big fan of low interest rates. I've never been a fan of low interest rates myself. We need to acknowledge that it hurts savers. They're not gaining. And so there is a huge downside to that. I think the Fed has been myopic, thinking that low interest rates are going to help the economy. I think that helps financial markets more directly than the economy. I don't think our economy has really been benefited. While today we're in a pretty good situation, as I just outlined, I think, from an unemployment perspective. I don't think that's the Fed's doing, attributable to low interest rates myself. Now, the Fed has said that they are committed to fighting inflation and have, under the leadership of Chair Powell, have outlined a modest increase of inflation over the next couple of years. And they are of the mindset that that will rein in inflation. When I compare what they're anticipating with what I saw and what the U.S. saw back in the early 1980s, it's no comparison. The Fed's expecting that they can get away with just increasing interest rates on the Fed funds from today's 50 basis points up to maybe 340, 350 basis points, 3.5% annual interest on the Fed funds rate. I don't see that as really being sufficient to slow the economy when inflation itself is well north of 6% on any basis. So I think interest rates are headed higher. I think the Fed has convinced financial markets, unfortunately, that they'll be able to bring in inflation with modest interest rate hikes. I think bankers should be prepared for more significant moves down the road, though.
So Jerome Powell calls you up and says, Scott, what do I do? What would you tell him?
I would say get serious about reining in inflation. 100 years ago, Irving Fisher, an economist, said, don't look at interest in an inflationary environment. Don't look at interest rates by themselves and think that's influencing decisions. In an inflationary environment, people compare the interest rates with the loss in purchasing power that they're receiving on their money. And so, people are in angst that the 30-year mortgage is, say, 4.5% now. Well, if inflation is, let's say, 8% now, then you're paying back 4% dollars, but those dollars are buying 8% less. So what you're really giving up in paying back that 4% is nothing in terms of purchasing power. You're better off borrowing. And I think that's what the Federal Reserve has failed to consider and recognize. And they focus attention only on, the Fed funds target rate, which economists say is a nominal interest rate. Nominal interest rates are fine when you have no inflation. And that's translating to loss or gain in purchasing power with no inflation. But our economy is not a non-inflationary economy. Really, to rein in inflation back in the early 1980s, nominal interest rates had to be driven up in excess, far in excess of what that inflation was. And so my comment to Chair Powell would be get serious. You're going to have to do a lot more if you really think inflation is going to be brought under control by the Federal Reserve in your actions. I think you're deluding yourself and the public to think otherwise.
Well, Scott, what kind of political pressures does the Fed have to deal with?
I think the Fed, that's part of the problem in my thinking. Really going back to 2008 and Chairman Bernanke, I think the Federal Reserve has been of the mindset that they need to politically keep interest rates low to sustain strong economic activity. And ironically, we haven't seen a sustained strong economy with this low interest rate environment. So the political pressure is, I think, two-part. One is this mindset that low interest rates will stimulate the economy, which I think is wrong. And the other is financial markets love the Federal Reserve. The Federal Reserve since 2020 and the onset of COVID has been saying we're going to be buying Treasury securities and mortgage-backed securities every month, regardless of the price. That's nonsense. That's not a market environment. It does, though, lead to financial market participants to run out and buy and front run the Federal Reserve in all of this activity. So financial market participants love the Federal Reserve, and that's one of the political pressures that the Fed is now facing. And I think that's why we've moved and gravitated to this low interest rate environment that's not helping us.
So do you believe, as we take a look at the midterms and then in 2+ years, another election, that they will continue to be politically pressured to maybe not doing the right thing, but maybe more the popular thing?
I listened to, so Chairman Powell, as you and the listeners know, has been renominated as Fed chair. And I listened to his testimony to Congress, and I was struck by the Republicans who were praising Chairman Powell for what he's done on monetary policy. And I think they're praising him because with COVID, what the Fed did and stepped in really saved our bacon initially. But what they're missing in praising him is he was completely wrong about what inflation was going to do. In 2020, for the first 3 or 4 months when COVID hit, the Fed stepped in, and I applaud that. But they should have got out of the way right then. And the Fed has made a serious mistake, in my estimation, by staying in much longer and trying to stimulate things by keeping interest rates low and telling financial market participants go out and buy this Treasury and mortgage-backed securities before we do. And that just further drives rates down, that's problematic in our economy. And I think I'm a registered independent, have been since I've been able to vote. I really can criticize both parties. I think President Trump was wrong in trying to keep interest rates low when he was in charge. I think Republicans today are also wrong by not blaming Chairman Powell for a lot more of the inflation problem that we're facing than he's getting blamed for. He did some wonderful things when COVID first hit us, but he's been way off. He thought inflation wasn't going to escalate, called it transitory for a while. Here we are, 8.5% inflation, and the Fed has done, I would say, almost nothing in response to that. I think the Republicans are missing an opportunity to stake out to the public that they don't like inflation and are opposed to Chairman Powell's guiding monetary policy.
Well, Scott, changing subjects a little bit here, how will the war in Ukraine affect our economy? Is that a short-term deal, long-term deal, combination of the two?
I think that's a difficult matter in that we really don't fully understand, I think, the objective of Russia in invading Ukraine at this point. So how long is this war and conflict going to go on? I think is, in my estimation right now, clearly unknown, and that's a problem. Right now, we're seeing that the conflict has obviously added some pressure in the energy sector. Oil prices have skyrocketed, and part of what we're seeing in recent pickup in inflation is attributed to that. We're also seeing agriculture prices react to the fact that both Russia and Ukraine are significant producers, and when they're in this conflict, they're not going to be producing to the extent they were before. So a major question is, how long is this conflict going to last, and will we be without their production worldwide? I think another factor, we haven't moved capital to make up for what's going on with the war. Obviously, petroleum prices are escalating. It's a bit strange to me that capital markets haven't moved more money into the production of oil in response. Oil is kind of an enemy now with the climate environment that we have. And I think that's one of the reasons that I'm pessimistic about inflation. I think it's going to be more difficult to rein in without serious production increases, both in the energy sector and commodities broadly.
Well, Scott, what's the biggest impact the economy is currently having on the banking industry?
Well, I would say I think the most bankers, and I'm a huge fan of community bankers myself. I've been an instructor at schools of banking, graduate school of banking at Colorado, and I was the director of the Texas Tech School of Banking for 25 years myself. Most of the participants that go to these banking schools are associated with community banks. And to me, community banks are a key ingredient to the strength of the U.S. economy. Unfortunately, only about 15% of the banking assets are in community banks, but most of it then is in the very large banks. 85% of what we see in the banking industry is in large banks. So I like to differentiate community banks from big banks. And I don't know, in talking about the banking industry, I think you're really forced to talk about what big banks are doing. Now, the one thing I do think that's wrong in the bank thinking is they are really also ignoring the adverse consequences of inflation. Bankers will tell you that net interest margins, for example, are being compressed, and they are. They're being compressed much more for the big banks than community banks. Community banks have really held up a little bit. But in both cases, that margin is quoted in terms of dollars you're gaining. And if inflation is in excess of that, you're actually losing purchasing power over time. And I would be critical of the banking industry for not appreciating what's happening with inflation and how it's really changed, and should influence our thinking about financial matters in particular. Irving Fisher said interest rates should exceed what people expect inflation to be. I agree. That's where we should be in this environment. And the Federal Reserve has really turned that on its head by targeting interest rates to be zero and wanting to be inflation, in their thinking, 2%. Nobody's made better off in terms of purchasing power in that economy. It's delusional, I think, on the part of the Fed and bankers today to just think about interest rates quoted in the dollar, which I call nominal interest rates, and not adjust those interest rates for loss in purchasing power in the dollar. The dollar is losing purchasing power in this inflationary environment. The dollar is getting weak.
Well, Scott, when you talk about community banking, what should community banks be thinking and or doing right now with all this, I use the term chaos going on?
That's a great question. And I really, I think community banks should be helping their business borrowing customers first and foremost, making sure that they understand that this is an inflationary environment and that you're being compensated for inflation in your business activities. I think we're delusional to some extent in our business thinking, and community bankers could help these small businesses, especially in adjusting to this inflationary environment. I also think community bankers should be putting pressure on the Federal Reserve to rein in inflation. It is doing serious damage, and we need to bring it under control. I know there's resistance on the part of community bankers to be critical of the Federal Reserve, and I think that's because the Federal Reserve is one of their regulators implicitly, and they don't want to be associated with criticizing a regulator. But at the same time, we need to see that by keeping our voices quiet, we've put ourselves in a very unsettled situation currently.
Scott, we talked about so many things, and we could go on for hours based upon your wealth of information. But if somebody wanted to get in contact with you, maybe ask you a question or get some more information about one of the things we talked about, what's the best way for them to contact you?
The best way is probably email. I still have my Texas Tech University email account. I'm an emeritus professor there. So my email address is Scott, SCOTT, .Hein, HEIN, N as in Nancy, at TTU, Texas Tech University abbreviation, .edu as an education outlet. So I do keep up with my emails, and that's the greatest email address for me. I would also say I try to pay attention to some social media. I like LinkedIn as a professional social media outlet, and I do post some stuff on LinkedIn occasionally on my thoughts about the economy and the banking industry. So that would be another place to look for me as well.
Well, Scott, I know you're really, really busy getting ready to go see some family in Houston here this weekend. So I want to thank you for taking time out of that schedule to visit with us today.
I really appreciate the opportunity, Chris.